everyone. This is Romulus with Backpack Trader. At the beginning of the month, I issued myself the April Stock Market Challenge. Why is it a challenge? April is typically the most bullish month of the year, even posting higher returns than the month of November, if you can believe that. Not so much so far this month. It's looking a little bearish out there. Hence, the challenge at the beginning of the month. You see what was going on? We had bullish tailwinds coming from the rally that developed from the middle of March. Rally, those green candles right there, those green bars, that means the stock market's going up. And if you get that many in a row, well, that's a rally, everybody. That was happening. However, that was also coming into a direct contradiction with the inflationary environment. This is an interest rate picture. Also, look at oil. Down a little bit here, but whoo, has it been going up the last several months. Also, we have the great reopening trade. Here's a basket of airline stocks, and they are still flying out there. What about the cruise lines? Not looking great, but not in the toilet either. And here, Marriott International just coming off of an all-time high yesterday. Again, April, typically the most bullish month, but that was coming into direct conflict with the incredibly high interest rates that we're seeing and a Federal Reserve that is going to continue to raise interest rates. And that's clashing directly with the great reopening trade. People all over the world anxious to go out and about, travel, and see the world. Well, that brings money, creates opportunities, and the business environment starts to perk up. So these two parts, the inflation and the great reopening trade coming into direct conflict with each other, and the stock market itself, the S&P 500, just kind of stuck. It's been in a trading range for the last several months. The issue became even more challenging when considering the fact that the general stock market, as represented by the S&P 500, hit an all-time high back on January 4th, and it is unlikely to go above that high for some period of time. In other words, the market right now is locked in both an intermediate and long-term downtrend. In the middle of the downtrend, though, there was an uptrend, short-term that is, right here, and now stuck in a trading range. So you can see all of these different factors, forces, tides, and waves moving and clashing and crashing against each other. That's the challenge. I believe, as you've heard me say several times, that at some point between now and the end of September, the markets, the indexes, and it doesn't matter which, you can pick that. You can pick the Dow, pick the NASDAQ, that's knocking on the door, the Russell 2000, doesn't matter. They're all going to be challenging these late February, early middle March lows and possibly going below them. So what do we do with something like that? Well, here's what I came up with the help of one of my long-standing Centurions, Greg. We created what turned out to be a phenomenally winning trade. And before I tell you about the trade, because I made a boatload of money in a very short amount of time, there's something I want to bring to your attention. I have a few different portfolios. One of them I call ACTA. Why do I call it ACTA? ACTA means beach in Latin, because ACTA takes so little time to actually trade. If you choose, you can spend the rest of your time at the beach. For something that takes as little time to trade and manage, the returns are pretty good, very successful. It has a long-term winning percentage, that's like a batting average, of better than 86%. The last year and a half or so, it's been even higher than that. And you can see there's been some pretty good years. 2020, spectacular. 2016, 2012, The best year, though, in the entire bunch was 2008. And you think, Romulus, you're cracked up. That was one of the lowest rated return years of the entire portfolio. However, you have to remember 2008 was the second worst year in U.S. stock market history. A lot of people out there lost 70, 80, even 90% of their money that year. ACTA still posted a double-digit return, just shy of 16%. Why am I telling you all this? To brag? No, absolutely not. I'm telling you this because this Wednesday, I am hosting, that's right, Wednesday at noon, I am hosting a free webinar, question and answer session about ACTA, how I put these trades together, how I find them, how I generate this level of return without taking a whole lot of my time. And I'd love to have you in for that as well. Again, this is open for non-Centurions. Centurions, you already know this stuff. So non-Centurions, new people to Backpack Trader, new people to Club Romulus, check it out. Hit the link below. Wednesday at noon. Okay, back to the trading action. First, let me tell you that this trade was active for only 9 trading days. Okay, and in those 9 trading days, it made 31%. 31%. Phenomenal winner, as I mentioned. Really fantastic. So, again, I'm faced with the challenges. Markets in a long-term, intermediate-term downtrend. Short-term could be up to sideways. Interest rates going higher. Federal Reserve is raising interest rates. There's a war going on. Inflation is just going a little bit nutty. On top of that, we've got the great reopening trade, which is positive for the economy, positive for a lot of companies out there. Again, you can just look at the stock of American Airlines and see how it's trading at a multi-month high. The basket of airline companies just about very close to breaking out to a multi-month high. So all this was clashing together. And I issued an April stock market challenge to myself to try to find, well, a return like this. And I really expected this to happen by the end of September. And I may re-enter this trade sometime in the next 3 to 6 weeks if opportunity arises. And let's see if something like this can somewhat repeat itself. Okay, so I chose the vehicle IWM. What is IWM? IWM is a basket. It's an exchange-traded fund that covers the entire Russell 2000. There are 3,600 stocks trading on the main U.S. exchanges, roughly 22,000 publicly traded companies all around the world, but 3,600 companies mostly in the United States. I'm not including pink sheets, bulletin boards, those kind of stocks, about 3,600. There are 2,000 of them in the Russell 2000. So most of the companies are in the Russell. They're small cap. They're small companies. They are not stocks like Apple Computer, which is the most valuable company in the world. They're not stocks like Tesla, which had a nice little run after earnings yesterday. They're not stocks like Google. Okay, they're very tiny companies compared to those, but they're big enough to make it on a main U.S. exchange. So good, viable operations for the most part. However, again, we're faced with a market environment that is looking down for the intermediate and longer term. This has been an area that has been getting hit probably more so than a lot of other areas in the stock market over the last 6 and even 12 months on the downside. Smaller companies tend to be a little more susceptible both to the upside and the downside. They're more volatile, in other words. And when the economy starts to get a little bit more difficult, which we will begin to see about 4, 5, 6, 7, 8 months from now, these smaller stocks start to suffer first and foremost. They're leading the way to the downside, in other words, right now. So I take this. This is the vehicle that I select. And I entered the trade back here on April 11th, right up there as it pops up, just shy of $200 per share on the exchange-traded fund. But I didn't just short this or sell it or look to profit from the drop on this. No, I came together with an idea of an option. You can go to Options Profit Calculator. This is a great place to find this kind of a site. Again, my Centurion Greg highlighted this to me, and we looked up a put spread. I'm interested in trying to make money as it goes down in value. So again, you go to this, just hit the symbol in, get the price of it as it comes up, and then I'm looking to put together 2 puts. Okay, that's right. I used put twice. Hey, even your old buddy Romulus, who speaks Latin, can put together a couple of decent phrases in English once in a while. The first option I want to do is I want to buy a put, okay? And I believe, again, that this all the action is going to happen at some time between now and the end of September. I'm not exactly sure when. The timing, as I just showed you, is a little muddled right now. Short term could be up, intermediate, longer term down. That clashing and conflict between the reopening trade, which is bullish, and the inflation, rising interest rate environment, which is bearish. And the war, of course, throwing everything into total chaos around that part of the world. So I buy this put, okay, the 190 put. I didn't pay this price. At the time, it was about $10.20. Okay, I buy that put, and I sell the 180. It wasn't at this price. At the time, it was about $8.15. So again, I buy this one, and I sell this one, okay? So we'll just load those in for now. Let's see, the 190. Buying that one, okay, and I'm selling this one, the 180, so I'm selling that right there. Again, prices were much different almost 2 weeks ago when I did this. Then you just hit the calculate button, and it does it all for you. And you can see that if IWM falls to 195 over the next couple of, now keep in mind, I did this a week and a half ago when the price was higher. So you could see that even from here, if it falls to 195 in a week or so, you see, you stand to make 10, 15% or so, okay? Now it goes there in a couple of weeks, down a little bit lower, and your return picks up. This type of strategy limits your risk. You also get a limited upside. But if IWM falls to 180 or so between now and the end of September, you could see that you're stand to make 160, 190, 210% on your money, which means I will try to re-enter this trade over the next couple of weeks if the market does what it's been doing, and that's rallying a bit after some selling and then selling a bit after some rallying. Okay, look, this is something I can talk to you about Wednesday as well. Again, I've got the free webinar question and answer session on one of my old favorites, ACTA, a portfolio that I manage that deals with ETFs, that trades only in ETFs. It's a swing trading portfolio, shorter term in nature, not same day trading, but shorter term in nature, very liquid, very limited and small downside risk, and extremely consistent. One of the most consistent trading operations that I've ever witnessed, experienced, or dealt with in my entire life. So I would love to have the opportunity to share a little more with you about that next Wednesday at noon. So just click the button below right there. You get to sign up. Again, this is not for current Centaurians because you guys already know this. All right, as long as we have each other, again, 31% in 9 days. 31% in 9 days. And I didn't need IWM to come crashing down. What really benefited me was a couple of things. First, a little bit of time decay, not much, but also the fact that the put that I sold, that was the one that really gave the value, okay? I got to buy it back for much less. I lost money on the put that I bought, okay? I lost money on that put a little bit, but I made money on the put that I sold. It's like going short, but essentially with a put. So that's a spread right there. Again, optionprofitcalculator.com. Check it out. Have any questions? You can always get in touch with your old buddy Romulus. Go ahead and click that link below that you see right now. That'll give you the opportunity to interact directly with me this Wednesday, April 27th at high noon Eastern time. Click the link. We'll send you the invitation. I very much look forward to having you with us there. So as long as we're together here, I don't usually do videos on Fridays, but today is a special occasion. That's right, celebrating an excellent, not just a profitable week, but a productive week, a good week of good sleep, a good week of good gathering with friends and family. Well, that was last weekend, Saturday and Sunday over Easter weekend. A good week time with family directly, with walks with my trusty steed, my little puppy, outside a bit. And we're going to be taking a couple of bicycle rides this weekend because the weather is now no longer frightful. And your old buddy Romulus loves a good spring breakout. I also love a good stock breakout. But hey, that's for a different day. All right, earnings continue to come out. You saw Tesla. They went out yesterday. They beat the estimates on revenues and earnings. Stock initially comes out real hot, fades a bit, but heck, 3% gain in a day when everything else was down anywhere from 1.5% to 3.5% on the indexes and some of the groups. Pretty decent showing. I've said for a while, though, that Tesla no longer has the ability, at least in the intermediate term and longer term, to get way, way back up here. It probably won't see those highs again for several years down the road. But again, a 3% gain in a bad day like that, not too shabby. Okay, Apple comes out next week. Google's coming out in a couple of days. Microsoft, in other words, the big tech stocks. And I don't think the big tech stocks are going to get Netflixed and have their subscriptions canceled. It's probably going to be more like a Tesla on some of them, or maybe a little bit downside on some of them as well, but not any major action either way. If they break out to the upside and they start to gap up in the morning, you probably see some fading. If they gap down big in the morning after a bad earnings report, you might see some pickup on that throughout the day. So just something to keep in mind as well. All right, this is your old buddy Romulus. I'm heading back to, well, you know it, ancient Rome. That's right. We've got chariot races. It's springtime, and I've got the fever. Thank you so much for the time. Come to our webinar. Click the link below. I'll see you next week. That's all for now.